Chapter 3. Diversification. Don't look for the needle in the haystack. Just buy the haystack. John Bogle. Textbook diversification strategy keeps assets in various unrelated classes, so one asset's downward movement is somewhat cushioned by possible upward moves in other assets. The classical division is to divide the investment portfolio between stocks, bonds, and precious metals. There is no shortage of different ratios, as advised by investment gurus. You will find 30 to 70, 40 to 60, 40 to 55 to 5, and many more. Diversification can indeed give you at least a more stable mindset when you need it the most. In 1952, Harry Markowitz introduced his legendary Modern Portfolio Theory, MPT, in which he demonstrated that an optimal return could be achieved if the portfolio is correctly diversified. He was awarded a Nobel Prize for developing MPT. For an average retail investor like you and me, finding the optimal ratio and successfully implementing it in our portfolio is difficult, if not impossible. In addition, developing an optimal model requires an immense number of assumptions about risk exposures of different assets and their behaviors in real market conditions. More often than not, these assumptions will not turn out as expected, in theory. Bonds and stocks should go in opposite directions, but this doesn't happen all the time. All assets go down, correlated or uncorrelated, in an absolute market meltdown, one more than the other. But all go down. All investors dash to safety and sell any investment they have without giving any thought about correlation. In choosing a portfolio, investors should seek broad diversification. Further, they should understand that equities and corporate bonds also involve risk, that markets inevitably fluctuate, and their portfolio should be such that they are willing to ride out the bad as well as the good times. Harry Markowitz. Sometimes, correlation of two assets can be hidden in plain sight. For example, in 1929, the stock market was overvalued, and prudent people refrained from stock market madness or kept some of their assets in cash as deposits with banks. Two asset classes, stocks and cash, completely unrelated. Think again. The stock market was on steroids of margin investing. It means an investor just needs to put 5% of stock value, and brokers finance the rest. Brokers were getting this money from banks, and collaterals of these loans to the broker were those stocks. Banks got this money from their depositors. Now you see the link. When the stock bubble burst, brokers give the margin call, and investors couldn't honor it. Brokers sold the shares, but the market was down. Selling pressure worked like a spiral, and eventually, losses in the stock market became defaulted loans on banks' balance sheets. A score of banks failed, and depositors lost their cash investment. Sometimes, a very apparent correlation doesn't work. For example, since 1950, the number of people traveling by aircraft is increasing. One can conclude that companies providing air traveling services should be doing well in such a long-time growth. It is a no-brainer. However, history is full of failed airliners. Pan Am, Eastern, Sabena, Swiss Air are just a few of the high-profile failures. Even the airlines who managed to survive didn't do particularly well, far from beating the rest of the market. Your gain or loss is always a weighted average gain or loss of your total portfolio in a true mathematical expression. If you have multiple assets in a portfolio, but it is too tilted toward one asset, you will get the returns leaning towards that particular asset's returns. Benefits of diversification. If you invest and don't diversify, you're literally throwing out money. People don't realize that diversification is beneficial, even if it reduces your return. Why? Because it reduces your risk even more. Therefore, if you diversify and then use margin to increase your leverage to a risk level equivalent to that of a non-diversified position, your return will probably be greater. Jeff Yass. Psychological stability in difficult times. In my opinion, the most significant benefit of a diversified portfolio is psychological stability when you need it the most. Suppose you are holding only one or two positions in your entire portfolio. In that case, it is challenging to face the daily inflow of terrible news, market fluctuations, and your urge to run for safety. Here is part of the trade-off with diversification. You must be diversified enough to survive bad times or bad luck, so that skill and good process can have the chance to pay off over the long term. Joel Greenblatt. In concentrated portfolios, market fluctuations are magnified. All market noises look like real events. You will try to link every news item to your stock and draw conclusions out of nothing. For example, you hear in the morning news that grocery costs per family increased by 1% compared to last year. You are holding Home Depot as a highly concentrated position. This news should be unrelated to your stock. However, Home Depot is about 70% of your portfolio. Your brain automatically links every news, related or not, to your stock. Your conclusion from this news clip is that since grocery is expensive, people will have less money to spend on home repairs, hence, less profit for Home Depot. You were sitting on a nice 8% profit on your position, and you don't want to lose it. Immediately after reaching your workplace, you put a market order of selling all of your shares. This move will look dumb for a person who does not hold a sizable position in Home Depot. But it was a rational decision for you. It is challenging for a human brain to distinguish between noises and threats if a considerable value is on the stack. If you are holding a concentrated portfolio, it is challenging to distinguish between the whole market move and your stock's price action. On a good day, usually 90% of stocks go up, and on a bad day, 90% of stocks may go down. If you hold only a couple of shares, all of your attention will be on those stocks. Every day you will think that your stock is going down or going to the sky. You will quickly lose the big picture and will make impulsive decisions about your position. Another impact of concentrated portfolios is that it is hard to distinguish between price action and change in the company's actual value. It should be easier to keep a good eye on a couple of stocks rather than hundreds of stocks, in theory. However, in reality, when you concentrate too much on a couple of shares, all price actions look real, and you will carry it to whatever fair value model you are using. You will convince yourself about the price action and will magnify in your head. Inevitably, you will make irrational decisions. You can indeed avoid selling a few times, but days in and days out, it is almost impossible to stay firm. There is only one way of doing it. Detach yourself entirely from market price and the daily news cycle. Reduction of losses. Suppose you are holding a diversified portfolio of uncorrelated assets. In that case, hopefully the downward trend in one investment will not impact other assets. Or if you are lucky, the loss of one asset may be a gain of another. For example, you are holding stocks of two pharma companies. One company is the market leader in one drug, and the other company is trying to get approval for an identical drug. There are two possibilities. Either this company will get the license or not. In both situations, one company will lose, and the other company will gain. If you are holding the stock of only one company, you need to be lucky that the decision comes in favor of your company. But if you are holding both companies, you are indifferent as far as this decision is concerned. You know that whatever decision comes, the sales volume of that drug will be within these two companies. It is a misconception that diversification will magically reduce the losses. It cannot be far from the truth. Diversification does not reduce losses, but provides a weighted average return of your portfolio. It means that your return will always be higher than the worst performer. Inversely, your return will be below the best performer too. It means if all assets in your portfolio are making losses, you will make a loss, a weighted average loss. The most painful lesson from the recent past is assets-backed securities in general, and specifically mortgage-backed securities, MBS. In theory, investing in one mortgage is riskier than investing in hundreds or thousands of mortgages. So, MBS is less risky than one mortgage. Now, instead of one MBS, you bought a bunch of different MBSs issued by various banks. Now you have a well-diversified investment in mortgage loans. Amazing product. What can go wrong? Now, we know that everything went wrong. At the start of the product, only high-value mortgages were accepted as collateral, and MBS worked very well and provided above-market return without a significant increase in risk. However, there are only so many homes and so many mortgages. To make more MBS, the banks got greedy and started filling new MBSs with low-quality mortgages. The year or two went well, but soon the default rate started creeping up. Investors noticed and either tried to offload these securities or hedge themselves with credit default swaps, happily issued by the same banks. MBS divisions of the banks kept producing new MBSs despite the fact that there were no buyers in the market. Now the banks have billions of dollars of MBSs that they couldn't sell and trillions of dollars of credit default swaps that they need to honor in case of MBS defaults. The rest is history. What we call the 2008 financial crisis. Capital protection. The most critical role of proper diversification is ensuring the bulk of capital is safe in case of disastrous events. Enron is one prominent example from early 2000. However, it can happen without significant fraud. Take GE as an example. A legendary company, an original Dow component, pride of American industrialization, and success story of capitalism. Or take Sears as an example. Both of these companies were Apple and Amazon in the recent past. No one could imagine that Sears would go bankrupt one day, or that GE would be struggling for survival. If you have invested all of your money in Enron, GE, or Sears, you would not be a happy person today. All or most of your capital would be gone. Proper diversification provides a hedge against the failure of one asset class. In the case of a black swan event, only a small portion of your capital is lost, and you will be financially alive to see the next day. Rebalancing. Diversification strategy may or may not involve a mandatory rebalancing of the portfolio. There are pros and cons of rebalancing, but let's assume rebalancing is good, and diversification provides an excellent tool to a periodic rebalancing of your portfolio. In theory, you will be selling at higher prices and buying at low prices, and if you keep doing it, then your portfolio return could be better than average. Disadvantages of diversification. There is no shortage of investment gurus who do not like diversification at all. Their arguments are: limits the return possibilities. Diversification may preserve wealth, but concentration builds wealth. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Warren Buffett. In theory, diversification limits the possibilities of portfolio return in exchange for capital protection. It is a kind of insurance policy where you pay a premium in the form of subpar returns, and in case of a disaster, you just need to pay your deductibles. For example, you can hold only a few high beta, high-flying stocks, and enjoy an overblown rate of return. However, if one of your companies goes under, you will lose a substantial part of your capital. To avoid that, you may choose to diversify your stock portfolio among established companies with heavy balance sheets and consistent returns, but slower growth. A portion of your portfolio may go to growth stocks, but not all. You give up some possibilities of high returns, but buy stability in exchange. More work for an investor. There is no doubt that diversification creates more work. It is much easier to invest all of your money in Apple and then watch it grow with decent dividend payments. However, if you decide to diversify, it takes time and effort. You will need to find stocks that are not related to Apple or benefits from Apple's fall. Just buying another stock will not serve the purpose. What if the other company is an Apple supplier and 90% of its sales revenue comes from Apple? Proper diversification means investing in uncorrelated assets, and investing in multiple assets needs multiple sets of knowledge, more hours of research, and more market following. It is definitely more work for an investor. Cost disadvantage. Investing in multiple assets is more costly than buying only one because of the transaction cost. However, there are ways to reduce the cost somewhat. Say, for example, you buy $1,000 worth of stocks every month. Instead of purchasing all shares in your portfolio every month, just take turns and buy one stock this month, and the next stock next month. Over time, you will save a lot of money. Another cost that is mainly hidden is more dollar spending in acquiring the required knowledge of investing in multiple assets. For example, buying stock in the semiconductor industry requires different knowledge sets than buying a retail company, buying Nvidia versus buying Walmart. Acquiring knowledge takes time and effort, plus sometimes knowledge is not free. You need to pay for it. Too much diversification. It is very easy for investors to engage in over-diversification. It is a common misconception that if you diversify, you don't need to learn anything. Just buy a bunch of stocks, and you will be good. Nothing can be further from the truth. No amount of diversification can replace investment research. If you want to invest, you have to learn. It is a proven fact that about 20 to 30 well-chosen stocks will provide enough diversification for a portfolio. Increasing the number of shares after this number only increases the work and will have minimal impact on reducing risk. Selecting 20 to 30 good stocks in unrelated industries is not an easy task. It takes immense efforts to follow 20 shares, so investors take the shortcut. They try to replace the efforts with more shares, hundreds of those. In their head, more stocks mean more diversification, but this is not the case in the real world. For example, on 9/11, if you were holding stocks of one airliner and one insurance company, or 10 airliners and 10 insurance companies, the impact would have been the same. An event that impacts the industry impacts all participants in that industry regardless. Some will take more hits than the others, but all will be affected. What to diversify? All investors need to diversify to some extent. There is no wise investor who puts all of their capital in one asset. Everybody does some sort of diversification. It is the extent and broadness that varies according to risk tolerance. It is essential to understand that legendary investors achieved extraordinary results with concentrated portfolios. However, the same investors do promote diversified portfolios for average investors. Warren Buffett has said multiple times that stock picking is not for everybody. All of us need to invest our capital to achieve financial freedom, but most of us are not equipped with the soul and skills to have concentrated portfolios. For average investors, proper low-cost diversification through a low-cost index fund is the only guaranteed way to claim their fair share of economic growth, as John Bogle advised. The index fund is a sensible, serviceable method for obtaining the market's rate of return with absolutely no effort and minimal expense. Burton G. Malkiel. How much, and what to diversify is a complex subject that has many dimensions. No one solution can cover all dimensions. Suppose you invest all of your money in a large conglomerate like Berkshire Hathaway, who has 70 different businesses. You are reasonably diversified as far as business type is concerned, but you are heavily concentrated in the wisdom of a tiny number of people. Diversification is a multi-step process. To achieve a decent diversification, you need to diversify each major attribute, like asset class, geography, economic sectors, market capitalization, time. Asset classes. First, diversification should be in classes of assets, which means assets should be divided between real estate, bonds, stocks, gold, etc. You don't need to invest in all of the categories, but should choose more than one. Not all of your assets should be in real estate or bonds, or stocks. Pick 2 or 3 asset classes and invest portions of capital with a percentage of your comfort. Once you have selected your asset classes, then you should further diversify. This means to keep buying apartments in the same building is not wise. Although it is easier to manage, you will be badly hurt if something happens to that particular building. It is wiser to buy apartments in different buildings, or, even better, in other cities. Once, we were looking for an apartment as an investment property and found a lovely apartment in a nearby city. All apartments in that building were sold about 30% cheaper than other buildings. We asked our agent for the reason behind this, and he said, about 20 years ago, a murder happened in front of this building, and this was the only murder that had ever happened in this city. Geographical diversification. Investors tend to invest in assets of their geographical region. For real estate, it is understandable to invest in the closest municipal area to service your investment. However, people heavily invest in local companies' stocks regardless of the size of the local economy in global terms. To achieve geographical diversification, you should consider investing in foreign companies as well. Economic sectors. The stock market is divided among economic sectors like information technology or financial services. These sectors are further divided among industries, like the financial sector has the banking industry, and the insurance industry or information technology sector has semiconductor industry and software industry. These industries are then further divided among sub-industries and so on. It is good to divide your stock or bond portfolio among some of the sectors you can understand. You don't need to invest in every sector. Choosing a few sectors should be enough. Market capitalization. It is a good idea not to invest in only large companies or only small companies. Spread your investment between mid-cap, large cap, and small cap. Time diversification. Rather than committing all of your capital at once, you can invest a portion of your money at a time. This gradual investment schedule reduces the chance of a sudden market drop right after engaging all of your capital. It is an excellent technique to relieve psychological pain. Dollar cost averaging is a method of time diversification. To achieve dollar cost averaging, investors invest a set amount at specified intervals, regardless of market condition. Most of the people who invest in their retirement plan practice dollar cost averaging. Many studies have proven that practicing dollar cost averaging is much better than waiting for a significant market drop. However, investing available capital as soon as it becomes available is better than dollar cost averaging over the long term. Suppose you receive a large sum like an annual bonus every year, and you want to invest the whole amount in stocks. You would be better off investing the entire amount as it becomes available, rather than dividing it into 12 equal monthly amounts. However, dollar cost averaging provides substantial psychological comfort in case of a sudden market downturn. How to diversify. Self-diversification. Self-management of diversification strategy is the most tedious and overwhelming task for a retail investor. As we have learned before, buying a bunch of stocks does not automatically achieve proper diversification. It is the thought process that does the trick. But it is not easy. It takes time and effort, often not possible for retail investors. Mutual funds. Mutual funds are money pooled by investors to achieve a common investment goal. Mutual funds can provide instant diversification without adding too much effort and cost. The history of mutual funds is as old as the history of investments. You can achieve better diversification through a mutual fund, but you need to give up control and pay some fees. Mutual funds can be of two types. 1. Actively managed funds. 2. Indexed funds. Actively managed funds depend on their manager's professional knowledge and experience, who is fully authorized to make investment decisions within the predefined investment strategy. Investment managers try to beat the market and try to provide an alpha to their investors in return for fees. Index funds, on the other hand, follow a predefined market index. These funds do not try to beat the market, but try to be the market. There are thousands of different mutual funds available to investors, from total world exposure to the thinnest possible niche, from multi-assets funds to single asset focus, from broadest possible diversification to incredibly narrow mandate, from traditional asset classes to exotic investment strategies. Exchange-traded funds, ETF. Instead of investing in a mutual fund, you can buy an ETF in the same fashion you buy a stock. ETFs are mutual funds that can be traded on a stock exchange. Like mutual funds, ETFs are available in thousands of different forms. ETFs have two vital advantages over traditional mutual funds. The first advantage is the ease of trade. ETFs can be traded in markets like stocks at any point in time. However, to sell an ETF, you need to find a buyer, and in the case of thinly traded funds, finding a buyer can be challenging. The second and much more critical advantage ETFs have over mutual funds is the lower management fee. The product of the ETF was constructed in such a way that managers do not need to spend as much as traditional mutual funds. These cost savings can be passed on to investors. Thus, a lower overall fee is possible. However, an investor needs to pay brokerage whenever an ETF is bought and sold. Investment in or withdrawal from a mutual fund is generally free. In recent years, ETFs gained enormous popularity and became the investment vehicle of choice for investors. Even some day traders and swing traders prefer to trade ETFs exclusively because, in this way, they can avoid company-specific risk. Chapter takeaways. All of us need to invest to achieve financial freedom, but most of us are not equipped for concentrated portfolios. Diversification is the most valuable psychological tool available to retail investors. Diversification does not guarantee protection from losses. It provides a weighted average return of the portfolio. Apparent correlation and absence thereof can be deceiving. Correlated assets may go in different directions, and apparently, non-correlated assets may go in the same direction. It is possible to overpopulate or over-diversify a portfolio for no marginal advantage or reduction of risk. Proper diversification can be achieved with a handful of assets. On the other hand, a poorly selected portfolio with hundreds of stocks and bonds can be inadequate for diversification purposes. Mutual funds and ETFs can provide instant diversification without adding too much effort and cost.